Hello everyone, welcome to Fearfully Greedy. This celebrates my 50th video and I bring you a new idea, which is the Seaport Entertainment Group. Before that, remember, I'm not your financial advisor. Consider this not financial advice. I do own this stock, so I'm playing my own book, so please do your own thing, okay? Okay, we'll talk about Seaport Entertainment Group, ticker SEG, in the New York Stock Exchange American. Okay, where does it come from? It's from a spin-off from Howard Hughes, which is this developer in Florida and other parts of the US. They have a lot of assets and they do these master communities. And for them, they acquired these assets some like in 2010 or so, and they developed them, but it never kind of worked for them. So the spin-off happened in the July 31st, 2024. And in a sense, it's like the good co, it's Howard Hughes, and then the bad co is Seaport Entertainment Group. I'm interested in the Seaport Entertainment Group. Okay, in 2010, they acquired. Well, it was spun off from General Growth Properties, who they also acquired these assets in 2004. I'm talking about the Seaport. It will make sense in a moment, but the story starts here, 2010, okay? 2016, they try to talk like this is a growing kind of neighborhood. People are making over 200,000 per household. Many hotel rooms are being built. Things are going like it's the highest growing place. And they were planning to spend $785 million in these assets to kind of revitalize the neighborhood. Okay, in 2017, they signed SPN in the pier, which we'll see what the pier is, and they also got a joint venture with the chef Jean George, which is very known in New York and across the world, who has Michelin star restaurants all across. And they expected to launch this concept, the team building, with a food court run by him. Also, at this point, they were planning to spend $785 million, so the same number. 2018, they acquired 250 Water Street. We'll talk about it in a minute, but it's like more land to develop. They start to see some worrying signs. The Seaport is taking longer to reach stabilization than anticipated, but we remain confident that the end product will be a spectacular asset for New York City and, as importantly, will generate attractive return on invested capital. But at this point, they start to separate the Howard Hughes numbers and the Seaport numbers, like all minus Seaport always. 2019, as of December 31st, 2019, they only had $177 million, which is mostly the team building. Seaport segment revenues 23 million compared to the prior year, so they increased 23 million, but the net operating loss increased to 15.7 million. Okay, so they were losing quite a few millions a year. And it's still impacted by the continued investment in the Seaport district. Okay, as we see, revenues now grew to 55 million, but the total loss for the segment, 59 million. So they, for every dollar in revenue, it's costing them two, which is ridiculous. Okay, 2020, the team building opening is expected in early 2022. Okay, remember this, the pandemic, big shock to the entire project. Now the costs are $788 million. And if we see the numbers, revenue went down to 23 million, so they were still trying. They did the greens, like a concept outside for social distancing and all that, but at this point they are losing 100 million, which is crazy again. In 2022, they saw a lot of increased foot traffic. Of course, it's back from the pandemic. Revenue higher 130% year over year. Let's see what the profitability was. The Seaport increased 41.6 million to a loss, the earnings before taxes, loss of 58 million still. So from 100 to 58, some silver lining, like we're going right direction. Net operating income decreased 1.1 million to a loss of 17.6 million. That's like for rent and assets. There's launches of new concepts to try to revitalize the segment, and that's probably what's improving some of those losses, but really not a big, like more revenues, less total losses, but the net operating income is pretty much the same. The Construction of the core of the shell of the team building is complete, and the marketplace is expected to have a grand opening in the first half of 2022, so next year. They hold the SP, so new overhaul over the entire branding of the Seaport in 2021, future opening of few concepts, one the Long Club, which is still running today, and maybe some silver lining at this point. Back to $55 million, back to losing $58 million that year. 2022, the team building just landed. They had the grand opening, the 250 Water Street. They are breaking ground and starting the project to develop. They want to build a big residential and mixed use building, and tremendous momentum. That's what they say. Tremendous momentum in the Seaport. 2 years later, they spun off the Batco, but they signed a 15-year lease. That's in the Fulton Market building to Alexander Wang, so they have their headquarters there now. 88 million now. Okay, so we're going a bit higher on revenue. Let's see the profitability. The aggregate cost to Seaport, excluding 250 Water Street, now it's only 40 million. So most of the costs are behind us at this point from the planned developments. Negative net operating income of 9.8 million, representing a 7.8 million improvement compared to the prior year. So at least we're going in the right direction, okay? There's some equity losses, which very important, of 36.2 million, okay? So 9.8 plus 36 were close to 50 million losses still. Because this is like equity losses, negative net operating income, but probably there's some management taxes also, management expenses, but the real numbers, 88 million revenues, it takes them $2 to generate those revenues, so $84 million in losses. Okay, 2023, they make a new kind of division in Howard Hughes, which is the Seaport Entertainment division, and they bunch all the assets we'll talk about in the video, and they set up the current chief executive officer, which is Anton Nicodemus, whose plan is turning this thing around. The idea already here in 2023 is spinning off all of this. Always the silver lining through these years was the rooftop, so the rooftop will be an important asset here. $82 million in revenue, so revenues are going down in other than that, normal year, but for poor weather, which will be something we'll also touch later. Net loss of $551 million. Don't take that into that. This is the real loss. There were some impairments to the assets because they invested so much and they saw no value on it, and they wanted to spin off the assets for a lower, a price that people would pay. And then also they wanted to take some losses for tax, like tax benefit. The team building by St. George net operating income was a loss of 38 million in 2023, and compared to 36 million, so they are already at 70 million. Just this joint venture. The Seaport net operating income totaled a loss of 15.5 million and decrease of 5 more million. Okay, so 2023 not great. Okay, revenues now 81 million. Losses, okay, there's the impairment and everything, but the losses were probably, we saw here 15 plus 38 plus some other costs. Still worst year that we ever had. Okay, then the spin-off comes, okay, and you will be asking, okay, this sounds terrible, so why do that? Okay, but first the spin-off was in August 2024. For every 9 shares of Howard Hughes, you get 1 share of Seaport Entertainment Group at $175 million valuation. Directly after, in September 2024, there's a rights offering, not a spin-off, a rights offering, up to 7 million shares at $25 a share, $175 million total, where Bill Ackman was backstopping. At that point, he was owning like 37% of the company. And he offered to fully backstop, which would make him owner of over 70% of the company. It didn't happen, so 39.5% at the moment. Okay, So let's talk about the assets. Let's see what's interesting here. There's 11 real estate assets in the Seaport neighborhood in New York, which is lower Manhattan, as we'll see. And then there's some assets in Vegas. Okay, let's go one by one. Okay, there's these 11 assets. Okay, when you see own improvements, is that they are on a land lease for 2.6 million. That's the total cost for all of them. So it's very low cost for the land, and it's for like 100 years, something like that. And they did the development, so they own that land, that asset, and they only have to pay like the rent for the land. Kind of low. That's very common in like big cities like New York. Okay, New York, lower Manhattan, next to financial district. Okay, the dot is where we would be. Okay, let's first. This is the biggest asset probably. It's the Pier 17, which is a pier looking the Brooklyn Bridge, 226,000 square feet mixed use, forever 50% occupied, and they were probably taking around $5 million in rent. A lot of these are estimates because they have never reported them, but I would say at 100% occupation, and probably if the neighborhood gets a bit busier, maybe they could bring in around $50 million. Let's add that like a 5% cap rate. I would say just the pier bottom floors at least $300 million. Okay, but there's also the rooftop, which I said is like the silver lining from all these assets, maybe of the neighborhood at least. 3,500 people fit at the moment, 180 to 200,000 tickets a year, 60 shows, around $100,000 profitability per show, $12 million in revenue. Okay, valuation, I would say 300 is just taking a bit on the space and the current rent per square feet on the region. The just development was $468 million. Current earnings is around $10 million, maybe 11, maybe 12. Potential earnings, I think more than 30 if they increase a bit what the rooftop can do. Okay, and it has won many awards as the best, well, place for events, some of those things. Okay, the team building. This is the bad part. Okay, this is where the fire is, and we need to extinguish it. There's the landlord operations, so we owned the building in a sense, and we get rent from it. So $12 million in rent is 55,000 square feet of culinary marketplace, which is, so the pier is right behind that way, and the Seaport district is this other way. There's 13 restaurants, 3 bars, some private dining, some retail space where you can buy fish and groceries. The numbers are crazy. They are doing $30 million in revenue, but losing $50 million. It's a joint venture with St. George, so only 65% of those we take in. Okay, so minus $33 million a year at the moment, I estimate, more or less. Development costs were $200 million. Conservative valuation, let's put this at 0. Potential earnings, I don't think this will be a huge thing. There's other food markets, food courts that they make a lot of money. This could get to this, but we just need to not be bleeding money. So maybe if it gets to 0 earnings but break even would be amazing. Fulton Market building, so it's this old building, it's 115,000 square feet. It's also like a good part of the assets. It's 100% lease, probably $12 million in rent, $8 million in probably net operating income. There's the Epic Theaters, there's Alexander Wang on the other side, there's the Lawn Club across the bottom part, and the Tuck Room, which is a restaurant up here. Okay, these 4 tenants, and it's fully leased. The Lawn Club is a joint venture, which we take some of the risk at the start, and then we just share profits later. Okay, development costs $60 to $95 million. We don't know exactly. Conservative valuation, I think at least 100 million, fully leased, like just from income, it makes sense. Current earnings, $8 million. Potential earnings, if the neighborhood gets hot, gets busy, probably $50 million. Doesn't sound like crazy, okay? Historic district is just a few assets across these cobblestone streets in New York City, which is crazy. Like, it's such a good spot, great asset in this concrete city. But it's first the Sherman Row, it's these ones here, it's a few assets, so we'll go one by one. Seaport Plaza, the bottom floor here, the museum block here. If you are not locating, this is the Sherman Road, this is the plaza here, the museum block is here, the Seaport Translock, so this is the museum, we're right here, this is empty at the moment. And then Bigman Street, which is a few streets more into Manhattan, which is empty also at the moment. And then the John Street Service Building, this, like the Fulton Market, would be going this direction, in this corner, this direction. And it's just a small building here, but there's been a few concepts because right across the sea, the team building would be here, the pier is that way, okay? All included, 90,000 square feet, mixed use, 33% lease. So these are the assets that are, since the neighborhood is not hot, they are not leasing well or not at good rates anyway. Valuation, probably it's been $86 million in cost, I think, just development, getting the assets improvements. The conservative valuation, I think it's at least $7 million. Just being in Manhattan, lower Manhattan, and it's next to the financial district, I think it makes sense. Current earnings, probably $3 million. Potential earnings, around 12, I would say. 250 Water Street is this 1 acre development site that they acquired like a parking lot and then they rebuilt it to make a building here. It's approved for 547,000 square feet market rate, affordable housing, office and retail. There's $60 million mortgage non-recourse on this asset, and there was a lawsuit so they couldn't build. That's when it was written down a lot. When they won the lawsuit, so things can progress and they can sell it. There's 421A New York benefits. That's huge tax savings that you don't pay a lot of taxes on the, especially on the housing part, which is the big part. So this just boosts return on investment for any developer. So it's a hot asset, I think. Just to put an example, in 2016, different times, different place, but the 80 South Street is that direction. They have another building next to this, okay? They sold that building because it's still a building. It has not been developed, but they sold it in 2016 for $390 million. Probably something happened there, but that was the price they sold it. And it's a building that they had to demolish, so probably that has increased costs, which should be cheaper. But then the location, it's kind of a bit better because it's kind of next to the river, okay? So maybe a bit hotter place, but just to have a few kind of examples. Just to show a bit what's sitting on the books. So start of 2023, it was on the books for carried value at the close of the period, 252 million. Gross amount, December 31st, 2022. So start of 2023, it was this. We are mid 2025 and 250 Water Street. The initial cost was the same ones, but now it's just carrying at 100 million less. So it's been written down for 100 million. And this was before the lawsuit was won. So there was a few more, I don't know, questions on these assets. I would say the development cost, well, they were $179 million to develop the asset. Conservative valuation, $143 million. I think that's safe. I think at least that it's there. You take the 60 million, it's 80 million cash straight in, that which we could use, or we could do a joint venture with someone that would develop. I don't think we have to go ahead and get a big loan just to build this. The current management, they are not developers, they are not builders, they are kind of hospitality, entertainment, they run assets, they get people interested into running these properties, and they do that, okay? If they want to develop it in-house, probably joint venture with someone, okay? 85,000 South Street is southwest of where we were. There's 21 units. This is John Service building would be right here in front of this. There's 21 units fully leased, $3,833 average monthly rent, and there's some retail space, well, office space down, 13,000 square feet, 100% lease. I would say $1.3 million in revenue, $0.9 million in profit. Okay, development cost 20 to 30 million. We don't know. Conservative valuation probably 20 million. Current earnings $800,000. Probably potential earnings if the neighborhood gets hot. We can raise rent. We can do some improvements. 1 to 2 million. I think that's safe. Okay, Las Vegas assets, 3 assets. Okay, we'll go one by one. We have a team, a stadium, and some rights above mall. The Las Vegas Aviators is the triple A minor league baseball affiliate of the Oakland Athletics. I mean the thing. Okay, it's the team is a minor league, of course, but they sell a lot of tickets. Well, a few tickets, $9 million in ticket sales. Probably they can do half of that in profit. Most of the cost of running the team it's run by the affiliate team, so maybe it's higher margin. I don't know exactly. I couldn't find real numbers for this, but we know the numbers from Las Vegas Aviators and then the stadium together. Okay. Development costs, they paid $33 million for this. Conservative valuation, 30 millions. I've seen teams in worse locations sell for 20, 25 million. Teams in better locations sell for 55, $45 million. Current earnings, I made an estimated guess. Potential earnings, $7 million. I think they can do more things if they get like number one in their leagues, things like that. Better fan base. Well, better, more fan base, more public, they can do better, of course. Las Vegas Ballpark, it's the stadium where they play in. It's in Summerlin, so it's like west of this would be Summerlin, so it's in the south of Summerlin. It's the stadium here. That's not that many new stadiums in Las Vegas, so it's something that it's very good to do other events in the off season. There's 10,000 person capacity. There's $40 million on mortgage in this asset, non-recourse to the company. 78 special events were run last year, and with the game tickets, so together with the other 9 million, they did $31 million in revenue. And yeah, it's on the books for $132 million. It took them to build it $124 million. It was constructed in 2018, so it's pretty new. I would say development costs and conservative valuation are pretty much the same. I don't think it's worth less than that. Current earnings, $10 million, together with the tickets and the drinks and the food and the events and everything. And I think this could increase substantially, especially in Las Vegas. So $20 million, I don't think it's a crazy amount, okay? Fashion show rights, so the last thing, well, not the last thing, but they have 80% interest on vertical development of the property. Of this asset here is the fashion show. It's a mall. It's the 25th biggest mall in all US. And if you see, there's been a lot of past and future vertical developments for hotels, casinos, those kind of things. There was a proposal for a casino. They never presented it to the Nevada application and anything, so it was never real serious. But Brookfield owns the bottom asset, and they own 20% of the above assets. So maybe they cash you out if they want to do it. They maybe do a joint venture. If they want to do it, they will have to pay you. Okay, I wouldn't give this much value, but development costs were probably 20 to 50 million. Seeing from other times that these air rights have been bought and seen it, but it's a guess. Okay, conservative valuation 0, current earnings 0, potential earnings 0. But I think we don't know exactly. There's no full disclosure, but there are no costs to this. Okay, now John George. Not a bad part. Let's say it's the guys that are running the team building, but we're trying to internalize more of that operation. But we have 25 interests in all the John George restaurants, which are 27 restaurants across New York, Miami, Nashville, Philadelphia. $9 million loss full year 2024 for us, which makes the entire group lose $36 million. So they are loss making at the moment. I think they can make it break even and eventually generate money, but still, $55 million we paid for this 25% interest. We also had access to more percentage, but at this point, with all these losses, we disregarded those rights to buy more. Conservative valuation is $0 million. Current earnings minus $9 million. Potential earnings maybe $10 million. I think with all these restaurants, it's not crazy that they can pull $1 million each, 300,000 each, something like that. I mean, I don't think it's anything crazy in the US. To sum it up, so I did all development costs with everything. The costs were 1.2 to 1.3 billion. Conservative valuation, the numbers I just did, $800 million. Current earnings minus 70, which a big part is the $63 million in corporate, which should be lower this year. We'll see. Potential earnings, I think if these assets, all of them are run well, as they stop bleeding, $100 million could be possible, I think. What's the bill? The bill is at the one $250 million for the entire thing. If we take enterprise value, there's some leases, the mortgages, and there's some net cash. Really, it's net cash for my calculation, but let's say the $250 million or $270 million. It's much different than these numbers. My bet is that this stops because the opportunity is here because these assets have been loss-making for many years. $7 to $9 million per quarter as of now. 1.5 billion were invested in these assets by, in my opinion, a sophisticated player in Huge, and they couldn't get to them to produce a profit. Let's see if the new management can. Just losses that seem to accelerate also. So things look bad. Okay, can the ship be turned? Okay, I think there's these 4 things that they have to run, maybe 3, the big part. Of course, stopping the bleeding at St. George's joint venture and the team building. Already in the first quarter of 2025, they internalized the management of the team building. They hired the employees that were running it before, some of them, and they just trying to tighten shop, closing some restaurants, maybe temporarily, maybe for a long time. The concepts that they were not working, they want to close. The concepts that were working, they want to increase. So trying to improve the economics there. From what comments I could find in Reddit and in Google, things are happening. They saw a few of the restaurants understaffed, still open, but understaffed. So I think they are trying to cut the losses. There was an article that you can find, just search, the food court that is losing $100,000 a day, which is crazy. Okay, I think stopping that, and I think the direction, they are doing steps. Let's see the next quarters what happens. Then new tenants that drive increased foot traffic. That's important because they will make the flywheel turn, the more revenues for all the other assets, more people want to start to be tenants here. And so it's all like this flywheel of revitalizing the entire neighborhood. Okay, we got Mule Wolf, which is a company in the US that they do kind of concepts, museums, escape rooms, a mix of the two, art in the middle, something like that, mix of art, storytelling, and interactivity. And they did a 20-year agreement. The lease is for 75,000 square feet in Pier 17, as we saw. Let's see what it is exactly. Okay, like it's these rooms, you can go with family, with kids. It's like a lot of visuals, a lot of local artists are doing these concepts. I didn't want to put a very long video, but you pay for the tickets and you go there, and it's similar on the trend of like escape room, but maybe more people can go. How much people? A lot of people. Like in Santa Fe, like the original place, on the first year they did 300,000 people. Subsequent years, more than 500,000. Las Vegas did over 1 million on the first year. The Denver concept, over 1 million in 9 months. Grapevine, Texas, we don't know the numbers. But if we take a look at what Vince Katlubeck, Mule Wolf co-founder and chief vision officer, said, we're creating something with a level of creative ambition and next generation storytelling that pushes beyond anything we have done before, an experience that truly belongs in the city. So I think they are trying to make their real flagship in New York, which, I mean, let's take a look at these numbers. Just by locals, I mean, New York is a different beast. In Manhattan, I mean, this is not out there, right? This is in the middle of the rock, okay? 64 million people visit New York every year. We'll see after this year, but I think the world won't stop very soon. So I think it makes, I don't know, I think they can pull even bigger numbers. I would like to know those concepts, the square feet they have there, to know a bit what the capacity is, but I couldn't find it. So I think it will be bigger than the others. It's some research I have to do also. Okay, new tenants, other new tenants. This because Mule Wolf is here. They agreed. It's being built, but until late next year, probably start of 2027, this will not be here. So at least more 15 months of construction for New Wolf. Maybe earlier, but count on that. So this is an investment for probably the next 2-3 years, right? So don't expect a quick gain here. Okay, we have the grand opening of Gitano, New York City, which is a Tulum-based group, which they do restaurants and nightlife and a bit of partying. It's not a club, but something like that. It seems fancy and fun. They just opened this month, well, May 2025. We're in June 4th. I'm recording this. And from the call that was right after the opening, it was great. They started on the rooftop to do concerts. So some new tenants, they are taking 13,000 square feet on Pier 17. Okay, I don't say things are going to turn in one day, but things were worse a year ago. This was not the least unoccupied percentages, but as of 31st of December, they were like this, 61 and 64. And I don't want to see things that aren't there. I want to be truthful, but look at these numbers. In place at the moment, 66%. So we increased 5% already in place. And then plan to be occupied 83% of the entire neighborhood. We are getting the pier close to 90%. Okay. And that's not all, okay? There's increased winter activity at the rooftop because they are making floor-to-ceiling glass, kind of cupola, like a closing place, because New York gets cold in winter, so no one is going to the pier, but they want to get more people there. So they signed a license agreement with the Rabbit. That was for Christmas, which is a famous kind of bar in New York. Then they did an agreement with Live Nation for 5 years, effective January 1st, 2025, for the entire year, okay? And probably they are starting to schedule concerts for the winter because they will have the seasonal floor-to-ceiling glass enclosure, they call it, okay? Commencing fall-winter 2025. So probably the low season for the pier will be not as low this year, okay? They had back-to-back sellouts on the rooftop, and they are very focused, I think, on capitalizing on the operational improvements, but more importantly, drive profitability and reduce the cash burn. That's their kind of goal that we saw in the call. They are still on pace to move forward with the rooftop window structure. This from the call a week ago, 2 weeks ago, should help us combat seasonality. Our intention also to develop 17,500 square feet, so the remaining 10% of the pier, which is right below the rooftop, they are making 2 rooms with glass on each side, and they can be joined together for events, for conventions, to drive more events there. It's 8,000 square feet main room, and they can hold up to 800 people. So I said, for convention, for company meetings, for maybe some annual general meetings, things like that, it could be great. And it's one of the few with these great views in the city and with such capacity, okay? So that's something important. And other things, I think the Las Vegas ballpark can be great. Of course, the joint ventures also, but the Las Vegas ballpark, I think they can do a lot of more events in the off-season from the aviators, and I think it's something they already have in mind, and they are scheduling for it. They had a couple already. And then on the Long Club, I think it's going great. They saw 5% revenue growth from our managed restaurants, including meaningful growth in the Long Club, which is somewhere you go for a bit for drinks, after work, you play a few long games. It's something that we don't have much. Well, I've never seen, but from the videos, from the photos, looks something I would actually do. Okay, so I like the stock, and I didn't like something else. I didn't like Playmates, the development of Playmates. I posted the video for Playmates start of last year, so it's been a bit over a year and 100 days. I lost 7% with the entire thing. This taking dividends into account because I sold a lower than I bought, but for 7,107 euros. Okay, so I sold the entire position. I think it's still cheap. I just think minority shareholders will never be treated very well here, and I also think the bull case is already not a possibility. especially with tariffs, but especially with the results from the last 2 years, even with the movies and all the media. And I sold my position. I don't believe. Well, I think there's better places. You can stay in the stock. I don't think it's. Well, it's not an advice. It's not financial advice. But I don't think I think it's super cheap. But I don't think we can release the value. That's the main problem. With that and some dividends and money that we had in the portfolio, I bought 500 shares of Seaport Entertainment Group at 19.46, so $19.46 for a total of 8,601 euros. Those are the two buys, 410 and 90. And then I sold 50 shares of Carvana. You thought I would never sell. I have not sold a big amount, but I sold 20% of the position. I bought at $8.90 and I sold at $326. That's a 33 bagger. Almost 34 bagger, which I didn't think I would get so early in the portfolio. A lot of the gains come from Carvana, so I also still believe in the thesis. I will not sell the other shares, at least in the next. I will keep you posted, of course, but I think it's great. I don't think it's going bad. I think the potential is there. I think it could get to 10 times the current size, no problem, and I think anyone that tries to compete with them will have a tough day, okay? I realized 14,265 euros from the sell. You can see here the sell on 2 days ago. And I bought more Seaport. So I bought at $19.78 now, 6,949 euros total. I bought 400 more shares 2 days ago also on the same day. And I also bought 10,000 shares of Naga Corp at 3.81 Hong Kong dollars for 4,264 euros. Okay, and these are all the buys. The portfolio at the moment sits like this: 132,400 euros, a 72,400 euro gain, 120% total gain, net asset value at the moment. The money weighted return for these 5 years, close to 5 years, has been 31.99% money weighted return. Okay, because this accounts for when the money went in. Because at the start we didn't have much money, I poured more money in, and it's been compounding. So good rate. I think a good rate. Carvana story was great. Of course, we'll try to find more of that, and we'll keep living that story because I said it's not dead. 44% is Carvana, 12% is Seaport Entertainment Group, 10% is Warrior Met Coal, Naked Wines is 9.3%, Naga Corp is 7.5%, Fidelis Insurance Holdings Limited is 6%, Pax is 4.4%, Pax Global Payments, Alibaba 3.1%, and the rest is cash. Okay, there's a link in the description where you can keep track of the portfolio live with all the buys, all the sell, all transparent. I try to share exactly all my success, all my failures on this investment journey. If you like the video, please consider subscribing. It helps me keep motivated. I will bring you more research, updates, all that. I will try to do more of these kind of videos. I enjoyed it more, I think, doing it. If you can give me feedback, that's also great. If not, no worries. If you have an idea that you would like to share with me, also put it in the comments. I would take a look at the company. And that's pretty much it. Okay, take care. Bye-bye. See you.